Weekly market update with AXR Investments for the week of February 24, 2025. The U.S. economy is facing some big financial shifts, but these also bring opportunities for smart investors. Here's what's happening and how it affects you. Number one, the interest rates are up, and that's not a bad thing. What's happening behind it? The era of near zero interest rates is over. The Federal Reserve, or the Fed, raised rates to combat inflation. The U.S. government bonds, treasuries, now pay over 4% interest, making them attractive again. What this means for you? If you're looking for low-risk investments with decent returns, treasuries are worth considering. The sweet spot is bonds with 1 to 5 year terms, long enough to lock in good rates, but not too long in case things change. What are the potential risks? Short-term bonds, which are T-bills, around July to August 2025, may be risky due to government debt ceiling debates. Number two, the U.S. debt is growing fast, and should you worry? So let's look at what's happening. The U.S. debt skyrocketed from $20 trillion in 2020 to over $36 trillion today, which is almost double. This is the biggest jump in history. A lot of this came from government spending during COVID-19, which are the stimulus checks, unemployment benefits, and business aid. Now let's look at what this means for you. Don't worry, the US isn't going bankrupt, but it costs more to pay off this debt due to higher interest rates. So, more government spending on debt means less money for things like infrastructure, social programs, and tax cuts. So let's examine the long-term outlook for this. If the trend continues by, say, 2054, a quarter of all government spending will go just towards paying interest on debt. The more debt the US has, the greater the chance of higher taxes or budget cuts in the future. Number three, a massive $7.5 trillion debt refinance is coming. So what's happening behind it? Over the next 3 years, $7.5 trillion in US debt must be refinanced, but at much higher interest rates. Old debt had an average interest rate of about 2.75%, but new debt is being issued at 4.5%. This means that the government will pay $94 to $131.5 billion more per year, just in interest. So what does it mean for you? Expect higher borrowing costs. Things like mortgages, car loans, and business loans could get more expensive. Investment opportunity? Higher interest rates make bonds, CDs, and money market accounts more attractive for saving money. Number four, debt ceiling drama is back and accepts some market jitters. So what's happening behind it? The US has a legal limit on how much it can borrow. Congress has to raise or suspend the debt ceiling to avoid defaulting. Historically, this has always been resolved, but political fights often create market turbulence. Right now, markets are pricing in a possible standoff during July and August 2025. So, what it means for you? Short-term treasury bonds maturing in July and August 2025 are paying slightly higher yields. A sign investors are nervous about delays in government payments. If you're investing in T-bills, avoid these maturing around this time to minimize risk. If a default were to happen, unlikely but possible, stock markets could react negatively in the short term. So, number five, how should the average investor approach this market? But despite all of that, there are some good news. The good news, higher treasury yields mean safer investments now pay better returns. Bonds and CDs are more attractive for people looking for steady income. Inflation is slowing and interest rates may stabilize soon. Challenges to watch. Rising debt could lead to long-term issues like higher taxes or cuts to government programs. The July-August debt ceiling fight could cause short-term market volatility. Higher interest rates mean borrowing, mortgages, loans is still expensive. So let's look at the best investment moves for right now. Consider Treasury bonds, 1 to 5 years. Safe, solid returns. Look at CDs and high-yield savings account, better than in recent years. Diversify into high-quality bonds. Agency mortgage-backed securities, municipal bonds, and preferred securities offer good options. Stay patient with stocks. The market may be volatile, but long-term investments are still valuable. Final thoughts. Stay calm and invest wisely. Yes, things are changing, but smart investors like you can take advantage of rising yields and protect themselves from unnecessary risks. Keep an eye on the debt ceiling debate and consider locking in higher returns when they're available. If you're unsure where to start, focusing on low-risk, interest-paying investments like bonds, CDs, or money market funds is a great move. And lastly, for legal financial advice from a certified wealth advisor, please subscribe to AXR Investments. Thank you and see you next week.